All right. So is everybody in, Nick? Is everybody in the room with us here? Trickling in. All right. We'll give it just a couple minutes. Thank you guys for coming to our presentation today on financial wellness in retirement and learning how to weather the storm. We've got folks online via Zoom, and we've got folks here in the room in person. So we're trying this out. My name is Gabe Bodner with Fairway Independent Mortgage and the Roof team.
I'm Andrew Christie with Flatirons Financial Planning here in Boulder and Northwestern Mutual.
Yeah, so we're going to give it just another minute or two before we jump into our presentations. But once again, as people are logging in via Zoom and people are still coming into the room here in person, just want to be respectful of everybody before we start too quickly. As we go through our presentation, Andrew's going to kick us off actually, and he's going to talk. And then when he's done, I'll jump in and talk for a bit. And then at the very end, we will open it up for questions in person and then via Zoom. You guys can have questions through the chat. So as we go through our conversation today, please feel free to use the chat. Please eat and go ahead. But yes, please go ahead and use the chat throughout our conversation today. Okay? Nick, how we doing on everybody in the room so far? Everybody in the waiting room? Awesome. All right. Well, with that being said, once again, my name is Gabe Bodner, and this is Andrew Christie. We're super excited for you guys to be here, both in person and over Zoom today. We're introducing this Financial Wellness for Retirement series. This is a monthly series that Andrew and I are kicking off. So really appreciate you guys being here with us today. Come back and join us next month on September, I think it's September 3rd, the second. Well, we've got a slide at the end, but it's the 7th, September 7th, first Tuesday of September. And without further ado, I'm going to turn it over to Andrew to get started and kick us off here. And I will step out of the way.
Thank you, Gabe. So for those of you who maybe walked in a little bit late, my name is Andrew Christie. I am a certified financial planner and retirement income certified professional. I work at Flatirons Financial Planning here in Boulder. And we work with clients who are approaching, entering, and in active retirement. The part of my conversation today, we thought we'd kick off our financial wellness series with the number one question facing most retirees today. Will I outlive my money? And recent surveys show that about 67% of Americans have some fear that they will actually outlive their savings in retirement. Tonight, we're going to talk about some strategies that you can use to plan for the unexpected in retirement, and specifically different approaches to address this fear. And in future wellness series, we're going to try and step through other risks to retirement, other strategies that can help enhance and improve retirement outcomes along the way. One of the first risks that is very apparent to retirement, and one of the biggest fears that I come across, is what happens when the market becomes really volatile. And most retirees are generally fearful of fluctuations in the stock market, things that we can't totally control. And we're looking at a scenario here to display this risk, which in the financial planner world, we call this sequence of returns risk. What happens if the stock market has a series of bad years early on in someone's retirement? And to demonstrate that, we put together a scenario where, let's just say a 60-year-old individual decides to retire, and they've accumulated $500,000 for retirement. Their plan is to withdraw 5% a year, which is a kind of a standard distribution rate number, arguably a little bit aggressive today. But for easy math, 5% is $25,000 a year. Now, if this couple retired in 1973, I picked that year on purpose, they walked right into a 2-year recession in the stock market. They find themselves in 1993 running out of money when they're 83 years old. Still have a lot of life ahead of them. They're still active. And this is assuming they have about half their money in stocks, about half their money in bonds, which is also pretty common for retirees when I meet them for the first time. Target date funds. Target date funds are when you tell Fidelity or Vanguard or your 401k provider, this is the year that I'm planning to retire. And those funds are automated to become less and less aggressive as you get closer and closer to that retirement date. And most of them land with about half your money in stocks, about half your money in bonds, or even more than half of your money in bonds. When we look at this scenario, we just run the same exact numbers for the same couple that retires instead in 1994, where they experienced the exact opposite, a run in the market for the first several years of their retirement. What you can see, using the same time frame, at 83, they have 3 times as much money as they started with in their nest egg, and they've withdrawn the same amount the entire time. Couples need a plan going into retirement. They need a distribution strategy for how are we going to handle the thing that we can't control, which is the stock market. And today, Gabe and I are going to walk you through a few different strategies and tools that you can implement into your financial plan that can help. It starts from my end with a sound investment philosophy. Every successful investor that I have ever personally met and worked with was investing for a specific goal and operating continually on a financial plan to achieve that goal. The opposite, every failed investor that I've ever personally met was market focused and event driven, continually trying to predict what was going to happen, what was coming down the road. And it's not too much of a stretch to realize that you have to guess right a lot if that's your plan and your strategy. But that's what many Americans are trying to do. And that's what they're led to believe they're supposed to do by the financial news media. I'd argue that a steady hand of an advisor, a written financial plan, and a specific goal in mind is always going to win over the long haul. That said, when I'm working with my clients, I set expectations around what the market will do. Based on 50-year historical average, we will expect a drop in the stock market by 10% every year. There will always be a reason for that, but it's very common, and it should never dictate, in my opinion, a change in investment strategy or change in retirement plan as a whole, unless someone's goals change. That's just what the stock market and equities do. Every 5 years, based on the same 50-year historical average, we'll see a 20% or greater dip in the stock market. This is a coronavirus pandemic. It's a mortgage crisis. It's a dot-com bust. Right? These things can never be predicted, and they cannot be timed. But if we expect them, we can plan around and through them. This brings me to another risk that I always like to point out for retired couples. It's a hidden risk. It's one that's not apparent, and it's not sudden and scary like a drop in the stock market. It's the risk of inflation. It's currently a buzzword. It's in the news media right now quite a bit. But the reality is based on a 30-year inflation average at 3%, someone entering retirement today who buys a $5 cup of coffee at Starbucks will pay $12 for that same cup of coffee at the end of their retirement. Everything around retirees is getting more expensive. And the most predictable way to grow your wealth and outpace the rate of inflation is ownership in great companies all over the world. It's buying stock. Specifically, not any one stock, but a diversified portfolio of equities, where you're hiring the best companies in the world, run by some of the most capable people in the world, to go out and improve profits and make money for you. Give it back to you in the form of a stock dividend. Reinvest it in the company and raise the value of your share. We have to remember when we're investing that that is what we're doing. The other option in a portfolio is a bond. This is where we're loaning money to those same corporations. This is far more predictable. It's even. It's based on interest rates, and they pay their bills generally. The problem is that fixed income or bonds over the last 15 years have averaged about 4.5% rate of return. If inflation is 3, and you try to distribute your money at a rate faster than 1.5%, like 5% in my example earlier, by definition, you have a plan to run out of money. And so while bonds are important and they serve a role, we need to figure out exactly how much do you need in your financial plan. Diversification is important. It's key. We believe you should never own enough of any one stock to make a killing. Because if you do, by definition, you own enough of that stock to get killed by it. And I think that this is the more investing becomes accessible to the masses through your smartphone, this is something that the average investor is very much in danger of today. Professional wealth management ensures that you have your money appropriately diversified. It also ensures that portions of your portfolio are always underperforming. And what that means is that you are truly diversified. You own all the pieces of the stock market is such that there will always be winners, there will always be losers. You can't predict from year to year who's going to win or what stocks are going to win. But if you own a diversified approach, you ensure getting all the winners. We've developed a methodology to approach retirement planning. And we did this by studying recessions. We went back and looked at every recession that we've been through in our country, starting with the Great Depression. And we realized that the Great Depression was an event unlike any we've ever experienced since. And the reason for that is after the Great Depression, the government instituted the SEC, the Federal Reserve Board, and a couple of very key pieces of legislation to ensure that it never happened again, and it's worked. But we still have recessions. And for a retiree, the worst one is actually known as the dot-com bust. This is September of 2000. The stock market begins to fall, and it falls for almost 2 years. Actually, 2 years, September of 2002, the market bottoms, almost exactly 2 years. And then it begins a 4-year recovery to reach where it fell from. So if you were the unlucky individual who retired January 1 of 2000, and you walked into that in your first 6 years of retirement, you needed to have 6 years of safe money, 6 years of money that was not in the stock market to rely on for your retirement income to get through that. And if you did, you were able to hold all the stocks in your portfolio down the roller coaster and back up to where they fell from. You survived that kind of recession. Today, our firm will plan for 8 years. Right? It's two additional years beyond the worst thing we've seen since before World War II. We do this by making sure our clients arrive well positioned to execute a retirement. This doesn't happen the day you decide to retire. And this cannot wait until you file your papers to retire and leave your company. In the years leading up to retirement, we're going to build a portfolio. I've created an example here for you guys to look at. This is a couple who's distributing $100,000 a year from their portfolio. They have Social Security on top of that, so maybe they're spending a little bit more. But I like easy numbers to work with. And if you have $100,000 that you need every single year from your portfolio, we're going to have you maintain the first 2 years in cash. For the first time in my career as a wealth management advisor, we experienced a sudden drop in the stock market. We all lived through that last year, a historical decline, down 34% in 33 days. The market has never fallen that far that fast. And I had clients, I had one family retired January 1st of last year, and I had another family scheduled to retire April 1st of last year. And our conversations led right back to this, reminding them that we had the next 2 years of their retirement income ready to go. It was right there. It was in cash. And it was not down 33%. And I asked them, is it reasonable to assume that the wealthiest country in the world will have this coronavirus figured out in the next 2 years. And without a heartbeat, both families said, yes, we're okay. We're going to move forward with our retirement plan in April. Now, today, we might think twice about that. This is still dragging on longer, I think, than anybody thought. But if this were to evolve into a prolonged recession, we're ready for that too. And in their portfolio, we've lined out the next 12 years and split it evenly between stocks and bonds. Bonds generally working inverse of stocks. Right? The stock market is struggling, the bond market is doing well. And we know that in any given year, as they spend that first year of cash, we can replenish it from either stocks if the market's doing well, or bonds if the market is not doing well. Now, bonds, as I stated earlier, are one solution to this safe money problem, and cash, we all know, is inefficient. So with the help of an advisor, there are different products and tools that are designed really well for this space, where the goal is not to go and outpace your stock portfolio. It's to enhance it and give you a better rate of return than we typically see on safe money. My company's designed products in the life insurance space and the annuity space, both of which are that need to be recommended by an expert and customized to your individual retirement plan. But if applied appropriately, they can fill the role for this safer money, provide additional guarantees and certainty, and not in lieu of a stock portfolio, but to enhance it so that you have optionality. You have the choice to sell stocks at the right time. If you've built this runway, you have the right to keep all the rest of your money in stocks. Everything that is not planning to be spent in the next 10 years should be invested in equities, because a diversified equity portfolio 10 years from now, at every point in history, has always made money. And it's been the most predictable way to grow your wealth and outpace the rate of inflation. I'm going to turn things over to Gabe. Gabe is going to talk about some new research that is in the mortgage space on how you can utilize your home equity to fill this same role. Because there are different solutions to this same problem. And not any one solution is right for everybody. That's why we recommend that you always get a personalized consultation from someone you trust. And if anybody online or anybody here in person would like to talk to us to see how this applies to them and their world, we would love to speak to you. But until then, Gabe, I'm going to hand the ball over to you, and then I will be back to address any questions we have online in the chat box or anybody here. Gabe?
Awesome. Thank you, Andrew. Appreciate that. Let me just adjust our slides here real fast. And should be off to the races. Good to go? All right. Well, Andrew, that was fantastic. Lots of great information. Appreciate that. And I will say there's a lot of information that Andrew talked about that will play into some of the information I'm going to share with you today. One of the things Andrew just finished with saying is that his firm creates an 8-year runway of cash, right, to be able to handle the financial markets, right, as I call weather the storm of retirement, because we all know, given history, the markets will fluctuate, housing market, real estate market, right, and the stock markets. So with that, we're going to talk a little bit about what I call the perfect storm. If I can actually get my slides to to go forward here. Hang on just a second. Oh, there we go. All right. Sorry about that. So as what I call the perfect storm, right? As we transition into retirement, we have to understand the makeup of our country. We've got 10,000 people turning 62 years old a day in our country right now. Fewer pension plans and defined benefit plans, right? The IBMs, the GMs, the HPs of the world are not paying their employees for the rest of their life once they retire, right? The 401k program replaced a lot of these pension plans, which means we have to fund our own retirements. We've got the lowest return on investment in decades in our country, right? CD rates from the 80s that were in the 12 to 15% range, those don't exist today, right? You go into your checking savings CD account, money market, and you're getting 1% or less. Andrew just talked about the fact that inflation is 3%. If you're getting 1%, you're losing 2% on an annual basis, given those numbers, right? So 76% of folks plan to delay retirement. Why? It's not because people want to work longer. In most cases, people don't love what they do that much, but 76% of people plan to delay retirement simply because they can't afford to retire any earlier. And as Andrew talked about, inflation is an absolute killer. It's on the rise. Okay, if you are not earning, again, 3% on your money or more after tax, you're literally losing money, right? So we have to figure out how we're going to deal with this situation. And look at that. 7% of folks have long-term care, and over 70% are likely to need it. That is a huge gap in our country's system right now for long-term care. How are people going to afford to care for themselves? And more than anything, we're living longer than we've ever lived before. Retirement was never intended as a 30-year time horizon, right? But now retirement is talked about in 30 years. So we have to plan for that. And as Andrew talked about, having a diversified portfolio, having the products, and having the appropriate mix of available cash in order to withstand the storms is excruciatingly important, more now than ever. Lastly, if you look at the bottom of the slide here, if all baby boomers retire at age 62, 84% of them would be likely to run out of money before they die. And if folks delay retirement to 66, half the country would still be likely to run out of money before they die. In my opinion, that is a pandemic. That's a challenge. That's a problem that we have to deal with. And at the same token, we have seen a 50% appreciation in home values from the peak of the market in April of 2007. This is before the housing crisis, the banking crisis, the drop in the market, right? But this is a 50% increase to include the drop in the market that we have. And you know what that's done for our country? It's created $9 trillion worth of home equity in seniors' homes right now. $9 trillion. That is more than $2 trillion greater than all of the 401k money combined in our country. Imagine, Andrew, if someone comes to you and gives you money and puts it into a 401k plan and says, I don't need it. I don't want it. I'm going to leave it for my kids. You ever get that, by the way? Never. Nobody puts money into their 401k with the expectation that they're not going to use it. We're going to talk about that in a little bit. But for some reason, people in our country put money into their homes with the expectation they're not going to use it. So what I'm here to do today is talk about a paradigm shift, a change in one's perspective. Because the reality is, the way we used to do retirement doesn't work anymore. Okay? The way that folks looked at a retirement mortgage, also known as a reverse mortgage, used to be considered the loan of last resort. It was for people who were in financial distress. And as Andrew talked about, there has been a phenomenal amount of research that has come out of the American College of Financial Planning and the Boston College. Folks like Dr. Wade Pfau and Barry Sachs and his brother have written books and white papers and articles that have actually proven and shown that today, used properly, you can not only increase your cash flow, but a reverse mortgage is best utilized at age 62 because of the growing line of credit. We're going to talk about that. So let me ask you guys a question. I talked about a paradigm shift, which means a change in one's thinking. Okay? When you go out and you travel into a new city, how do you get directions? Do you use a Thomas guide? I mean, do you know what a Thomas guide is? You don't even know what a Thomas guide is, right? Rick, you know what a Thomas guide is. Don't shake your head that you don't, but you don't use it, right? Tamara, you know what a Thomas guide is. I grew up, my parents used a Thomas guide, right, to look at where they were going, to get directions, right, and a map book. And oh, by the way, if you ran over the page, you had to find the next page to where you were going. And if you went to a different county, you had to go find a different map book for the other county that you were driving to, which is absolutely insane to think about. Of course you don't do that. Nowadays, you've got your directions and your map right there on your phone, right? The point of that is how we do things today is different than the way we did things 20, 30, 40 years ago. The way we do retirement today and in the future needs to be thought of and done differently than the way we used to. So that brings me to, what is a retirement mortgage anyway? It's also known as a reverse mortgage, but what it actually is what I call a payment optional mortgage. Pay when you want, if you want, or never make a payment at all. You're still responsible to pay taxes and insurance and maintain the home, but it's a payment optional mortgage. That's it. It's actually that simple. Many people think it's a lot more complicated than that. Okay? So you don't make a payment, the interest is deferred, which is what we call negative amortization. So the loan balance goes up over time versus down, right? That means that we're converting a portion of our equity to usable tax-free cash while maintaining ownership. Yes, while maintaining ownership. You are not giving up ownership of the reverse mortgage. Okay? But here's the best part of all. This is what we call a non-recourse mortgage. You can never owe more than the value of your home, ever, period. It is safe, and you can never pass on a debt or a liability to your heirs. Okay, so again, payment optional mortgage, you can never owe more than the value of your home, and you cannot pass a debt onto your home. So let's talk about some of the basics. Okay, you have to be at least 62 years of age or older to qualify. There are programs out there, and we have them, that allow you at age 60 to qualify. You do keep title to your home. You absolutely keep title. Again, you're not giving up home ownership. You must maintain that as your primary residence, which means you must live in the house for at least 6 months per year. But you can travel. You can own a vacation home. You can own multiple homes. But the home that has the reverse mortgage must be considered your primary residence. And it generally won't affect Social Security or Medicare. I say generally because I'm not a financial advisor. Andrew is. He can tell you more certainly, but I'm not a tax advisor either. I will tell you, though, that the proceeds received from a reverse mortgage, and we're going to talk about how you can receive the proceeds, are not considered income. Again, the proceeds are not considered income, therefore they're not taxed as income, which is why they don't impact Social Security or Medicare benefits. Okay? A couple other basics here. It does not require repayment until the last living borrower permanently leaves the home or you decide to sell. You don't want to live in the house anymore, so you sell it. Just like if you had a regular mortgage. You sell it, you pay off the reverse mortgage balance, and the proceeds are yours. Or you can live in the house the rest of your life and you never have to worry about making payments. And the loan gets paid off 6 to 12 months after you're gone. Your heirs get to sell the house, pay off the mortgage balance, and keep the proceeds. Okay? Again, you nor your heirs can ever owe more than the value of the home because it's a non-recourse mortgage. And one of the big benefits here as a realtor is you can utilize a reverse mortgage to buy a new home. So that means you could literally go in and put around 50% as a down payment, go acquire a home of your dreams in retirement, and put 50% down, which means that a client or a buyer can double their buying capacity. They could literally double their buying capacity with a reverse mortgage and never have to worry about making a mortgage payment. So let's talk a little bit about what I call the 3 buckets of retirement. Okay? We all have these 3 buckets. Bucket number 1 is your income bucket. Bucket number 2 is your nest egg bucket. That's what Andrew and his team focus on managing. And then bucket number 3 is your home equity. That's actually what my team and I help to manage. We help clients build this bucket, number 3, that we call home equity, in order to utilize that bucket strategically later on in retirement. You see, everyone has these buckets. And when you're in your earnings years, let's focus on the top half of the slide. You're in your earnings years, okay? And you're going to pull out money every single month, and you're going to take cash out of your income every single month, and you're going to pay your expenses, right? All your expenses, your food, right? Travel, clothing, gifting, all that comes out of your bucket number 1. And your financial advisor, Andrew, correct me if I'm wrong, but your financial advisor is going to tell you you should put 5 to 20% of your income into bucket number 2. Okay? As much as you can. 5 to 20% of your income into bucket number 2, right? And your advisor is going to help you to diversify that bucket, as Andrew talked about, into different assets and different classes, right? Why? Why do we put money into bucket number 2? So we can retire someday, right? We're not putting it there for our kids typically. We put it there so we can retire. But you're also putting money into bucket number 3. You may not know that, but when you go to buy a house, your down payment goes into bucket number 3. Every mortgage payment you make goes into bucket number 3. All your home improvement goes into bucket 3. Okay? The difference is you're converting cash to home equity. This is home equity. Looks like cash, but you can't take this to the supermarket or the grocery store and go do anything with it, right? So home equity is illiquid for all intents and purposes. Okay, so let's focus now on the bottom half of the slide. Let's say you want to retire someday. And when you go to retire, you find that your income, for most people, is going to be reduced. You transition to a fixed income, Social Security, pension plan, maybe hardly any income at all. Maybe rental income, if you own rental property. But most people find that bucket number 1 becomes reduced in retirement. However, if we followed our financial advisor's plan and what Andrew talked about, we put enough money in bucket number 2 so that we can pull money out in order to supplement our loss of income in retirement, right? Here's the catch. Remember that first slide? 50% of folks are in jeopardy of running out of money if they retire at age 66 or prior to that. And what Andrew talked about is sequence of returns risk, because we can't control the market. So what the reverse mortgage allows one to do is be able to put a spigot on their home equity in bucket number 3. And what we're able to do is reverse the process. Remember, we put all that cash over the years into bucket 3 to convert it to home equity, which was illiquid, we established. So the reverse mortgage just allows you to reverse that process. It allows you to take equity back out, convert it to cash, tax-free, if nothing else, to preserve and to protect bucket number 2 so that bucket number 2 lasts longer, right? It really is that simple. So let's talk about some strategies of what that spigot I talked about is, how you can pull money out of bucket number 3. First strategy is called a lump sum. This is where you can go out and purchase a property with a reverse mortgage. You take a lump sum of cash and go buy a property, or refinance an existing mortgage. Let's say you owe money on your house today. You can use a reverse mortgage, pay off that current mortgage. That's a lump sum. The secondary strategy is a monthly payment plan, where you can actually withdraw from the home equity and receive payments every single month like clockwork. And you can do it for a period of time, or you can do it for life. That's a 10-year payment. And Andrew and I are actually going to talk next month about tips on how to maximize Social Security. This strategy becomes a key strategy in maximizing Social Security, because you can create a 10-year payment, potentially at the age of 62, in order to delay collecting Social Security. Now, I don't want to give away Andrew's secrets, but at the same time, the 10-year payment and the term payment allow one to create monthly payments improve cash flow in order to either delay Social Security, capitalize on required minimum distributions at a later time, and so forth. Lots of different strategies. But the most powerful strategy of all is the line of credit, because the line of credit is still non-recourse and it's guaranteed to grow. I'm going to go through an illustration here and show you what that means and what that looks like. But once again, the line of credit works similar to a home equity line of credit. A lot of people are familiar with a home equity line of credit. However, this is, again, non-recourse and it's guaranteed to grow, which means you get access to more and more equity the longer you live in your house. So quickly, I'll go through just an illustration on the lump sum. This applies to anybody who still has a mortgage and is still making a mortgage payment. Because a lot of folks tell me, well, Gabe, I've got a great low rate, right? I've got a 4% rate, maybe even lower today. And I only owe $200,000, so my payment's less than $1,000 a month. In this illustration, $954 a month. Not a problem, I can afford it. The affordability is not my concern. What my concern is the $343,000 that mortgage is going to cost you, and where is it going to come from? It's going to come from bucket 1 or bucket 2, and just simply going back into bucket 3, which is illiquid once again. So the reverse mortgage is a great strategy for someone who's 62 to be able to get rid of that mortgage payment and improve cash and cash flow. Okay? That's an example of a lump sum. But as I said, my favorite feature of all is the line of credit. Here's an illustration of a line of credit of a client who's 62 years old and a home value of $600,000. What this shows you here is that at 62 years old, given current interest rates, and at the bottom of the slide, this illustration shows current rate at 3.51%, expected rate, and home appreciation rate of 4% annual appreciation. And what this shows me is that the client at 62 years old can get a line of credit, a reverse line of credit, for over $281,000. But remember, I said it grows. So as this client continues to age, by the time they're 89 years old, the line of credit becomes greater than $828,000. That truly becomes their 8 years worth of tax-free cash that they can utilize on demand. And I'll show you an illustration of what I mean by that. Now, one thing that clients do get concerned about when we talk about the reverse mortgage and the line of credit is that it's actually an adjustable rate feature. And many clients say, well, hold on a second, Gabe, I don't like adjustable rate mortgages. I say, I know, neither did I. However, you take a look at this next illustration. And what this shows you is that if rates go from 3.5% to 6.5%, check out the line of credit at age 89 now. And by the way, I tweaked the home appreciation from 4% to 3%, because some people don't actually believe we'll see 4% going forward. So that's fine. We'll look at 3% appreciation and interest rates, quote unquote, skyrocket to 6.5%. Check this out. By the time the client's 89 years old, they have access to $1.8 million and their home value is just over 1.3. Does anybody see a problem with that? What's the problem? Anything? You're going to owe more than the house is worth. Yeah, you'd think, but remember, I said you can never owe more than your house is worth. So this client actually has access to $1.8 million tax-free funds on an asset that is only worth 1.3 and change. And it's non-recourse, and the client cannot pass a debt onto the house, and they still keep ownership, and they still don't have to make a payment as long as they live in the house, pay their taxes and their insurance. So I say, great, let rates go up, right? Because the thing about this program is the line of credit growth rate is tied to interest rates. So if rates go up, your asset, right, your home equity is growing as well, which gives you access to more tax-free cash than you had before. Okay? So let's put this all into play now. All right? So as it relates to what Andrew talked about, and Andrew and I actually didn't put these slides together in this way, meaning that my illustration here shows you a 20-year history of the market. These are actual returns in the market from the year 2000 through the year 2019. And what you'll notice here is a client with $1 million IRA who takes a 4% annual distribution every single year. And you know what, Andrew? They actually are not at risk of running out of money, right? In that 20-year history, they theoretically will still have $941,000 in their IRA. Theoretically, okay? Not bad. However, let's take a look at something. As we talked about, and Andrew talked about this term sequence of returns risk. If you see the bottom of the slide, the market averaged over 7.5% rate of return in that 20-year period, right? What I'm suggesting, that on-demand line of credit, is simply this. Take the line of credit, right? Convert some of your illiquid equity to usable tax-free cash and use it, if nothing else, in the down markets, right? Because we don't want to pull money out of the market in the down markets because we lock in those losses. So this illustration simply says, okay, in the 5 years that we had a down market, right? And Andrew, you're right. You talked about 2000, 2001 as two back-to-back down years. Okay, all I'm saying is in those 5 down markets, instead of utilizing your IRA and pulling money out of that, turn to your line of credit. And you'll notice that pulling money out of line of credit is only $32,000 instead of $40,000, right? Because it's tax-free money, so you actually don't have to pull out as much. You follow me? So in those 5 years you pull out funds, look at the bottom line. Look at the bottom line. You've got $1.67 million in your IRA, and you still have over $400,000 left over in your line of credit available. So what does that really mean in conclusion? Okay? With no reverse mortgage or home equity conversion mortgage in the line of credit, you're not bad off. You have $941,000 after 20 years. However, your IRA could be over $1.6 million, which means your IRA could be over $736,000 greater in value. In addition to that, okay, you could have liquid assets when you add in the line of credit of over $1.1 million of liquid assets just by utilizing this coordinated strategy and the line of credit in those 5 down years. And you say, well, but Gabe, hold on. You took money out of your reverse mortgage, so you owe something. And there's deferred interest, right? And it scares people. Okay, fine. Let's take a look at that. You owe $246,000 of the 5 years you pulled $32,000 out. So let's subtract that out from your overall net worth. And your net assets are almost $500,000 greater in that same 20-year period without having to sacrifice lifestyle, cash flow, or anything at all. I hope this illustration makes sense and is clear in the sense that, once again, in an orchestrated or a coordinated strategy, creating the line of credit as a buffer asset, as a cash asset, as a tax-free asset, if nothing else, to preserve and protect the rest of your portfolio is just simply financially smart. It really is. If you want to do any research on this, you can check out Dr. Wade Pfau. He's written multiple books on this. He's done Monte Carlo simulations. He has done all of the research. He is a PhD from the American College Financial Planning who wrote the course for RICPs. Andrew is an RICP. That's a Retirement Income Certified Planner. And Dr. Wade Pfau has written a book on exactly how this works. This is his research I'm showing you here. So in conclusion, I'm going to go through just a laundry list of different ways of how to utilize a reverse mortgage. Number one, refinance a standard mortgage into a reverse mortgage. If nothing else, eliminate the mortgage payment. Number two, as a standby portfolio protection, Andrew talked about the importance of having 6 to 8 years of cash on hand. He also talked about the fact that if you're sitting in cash, you're losing money due to inflation. So having this as your standby cash portfolio actually provides more efficient use of money than sitting on cash. Once again, replaces the need for the cash bucket so that you don't have to worry about, again, the loss due to inflation. Ability to purchase needed insurance or investment products, excuse me. This, again, because of the increased cash flow, we have many, many clients who stop making a mortgage payment and redirect that payment that they would otherwise be making to their lender and redirect it to ensure that they have the right insurance, whether that's long-term care insurance, whether that's life insurance with a rider. That's Andrew's specialty or one of his specialties. Again, the idea that we can redirect funds because of the improved cash flow. Purchasing an investment property. We have numerous clients talking about the strategies now in retirement of utilizing some of their home equity, taking that out via a reverse mortgage, not having to make payments, and utilizing that cash to acquire a rental property or a vacation home because everybody is looking to get into real estate these days. Everybody has seen the appreciation. Here's another great strategy. Long-term care insurance. We talked about the fact that 7% of Americans have long-term care and 70% are going to need it. Okay. This is a huge piece of what we talk to our clients about is that long-term care plan. Bridging the gap between Medicare. Unfortunately, we've seen way too many clients who are forced into retirement earlier than expected. In many cases, that's due to the pandemic and the COVID-19 virus that we've seen. But many people were forced into unemployment, and many people in their 60s, I hate to say it, but are less marketable, unfortunately, and have struggled to get back into the workplace. And because Medicare does not kick in till 65, this is a great way to cover insurance. And a potential hedge against the market. Once again, this goes directly back to that illustration with sequence of returns risk because that line of credit is guaranteed to grow. Gifting to family, I'm a huge proponent of this, right? Many people, statistically speaking, I will tell you, 99% of seniors want to leave their home to their children. 99% of children don't want their parents home. It's a disconnect. You want to leave money to your kids? Give it to them now, right? Help your kids, help your grandkids today. Due to inflation, we talked about inflation, the power of giving them money today and allowing them to invest that into real estate or a 529 plan or a life insurance policy. And the compounding effect of that is much more powerful than letting them inherit it 20 years from now. And gifting to nonprofits. There's a lot of folks out there who just want to be extremely charitable, right? This is a great way to use tax-free money for gifting purposes. You get the full tax benefit and it's tax-free funds, as opposed to taking money out of a taxable account, having to pay the taxes, and then get the gift benefit. All right. That wraps up how we doing on time. We pretty good, Andrew? All right, good. So I'm just going to give you a quick plug for our next event, which is going to be on Tuesday, September 7th from 5:30 to 6:30. We will send you all an invitation to that. Andrew and I are going to be talking, mostly Andrew will be talking about tips on maximizing Social Security and strategies on how to do that. At this point in time, we will open it up for questions. You've got our contact information on the screen. If you'd like to use the chat, please go ahead and put your questions in the chat. For those of you in the room, please feel free to jump in and ask any questions. I'll call Andrew back up here at this point in time. But before I forget, I do want to thank you all for attending. We had some folks in the room here. A couple folks couldn't attend, but thank you all for being here online as well. So with that, do you folks have any questions in the room? And Nick, again, if you've got any questions on chat, please go ahead and let us know.
There's a couple questions on chat. Tony has asked, is the reverse mortgage only applicable to primary home? How about other investment?
Yeah, great question. So the question was, does the reverse mortgage only apply to primary residence or can it apply to investment properties? And the answer is the reverse mortgage must be on your primary residence. But once again, you can use the proceeds from the reverse mortgage on your primary residence to acquire an investment property. I was talking with a client actually today who has a traditional mortgage on his primary residence and has a traditional mortgage on a rental property. And we're talking about getting a reverse mortgage to eliminate the mortgage on the primary and eliminate the mortgage on the rental property to significantly improve cash flow. So just on the primary residence though. Good question.
And sorry, Andy, this one's for Gabe also, but David has asked, can you address the cost of setting up a reverse mortgage?
Yeah, David, thank you for the question. David asked the question, can you address the costs of setting up the reverse mortgage? I'll answer it this way, is that every situation is catered to the client's needs, okay? Generally speaking, more than 80% of the reverse mortgages that we do are FHA insured reverse mortgages. However, there are 20% of reverse mortgages that are not insured by FHA. They're still non-recourse. The fee structure is very different, okay? So again, David, I'm happy to, excuse me. Yeah, it was David. I'm happy to talk to you directly in your situation on the fees, and we can put together a plan and a strategy for you. Generally, there's mortgage insurance. If it's an FHA insured loan, we charge a loan origination fee, and then there's what we call third-party fees. So there's really 3 categories of fees. And once again, I can go through and break that down for you in your particular situation. Any other questions, Nick? No? Awesome. Anything to add at this point?
Nothing today, just looking forward to next month and diving into Social Security.
Awesome. You guys have any other questions in the house? No? All right. Well, again, thank you guys for attending. Andrew, great information. And with that, we'll go ahead and sign off the chat and sign off the Zoom for now. But again, appreciate y'all attending. With that being said, lastly, thank you for the reminder tomorrow. But go ahead if you want to bring one up to me. I appreciate it. Don't open it because it's bad luck. We've got a couple umbrellas to give away. So if anybody who has attended over Zoom, if you would like to receive your umbrella, go ahead and just reach out to myself and we'll make sure we mail you an umbrella. This is really about, as I like to say, get the umbrella before it rains. You saw my first slide about the upcoming storm in retirement. And really, it's just so important to really get that umbrella as we talked about and plan as Andrew talked about and go into retirement with a plan. So thank you for the reminder. And once again, thank you all for attending.